Hi, my name is Moyo Babalola, an investment principal here at Aria Capital, covering investments in the Western African region. Today, I'll be talking about emerging trends in 2026 to look out for, specifically the evolution of private markets and why local capital providers in Nigeria are turning towards private credit. Private markets are rapidly evolving into one of the most influential engines of global finance. From $2 trillion 20 years ago to more than $12 trillion today, private markets now drive innovation, infrastructure, and long-term economic transformation. Three major forces are shaping this evolution, and they are particularly relevant in Nigeria. First, the global shift towards staying private longer has made private equity a cornerstone of growth capital. But in Nigeria and across many frontier markets, exit challenges remain significant. Liquidity constraints, shallow capital markets, currency volatility, and limited strategic buyers often delay exits and suppress valuations. These structural bottlenecks mean capital can remain tied up for 7 to 12 years. As a result, many institutional investors are increasingly turning towards asset classes that offer shorter durations, clearer visibility, and more predictable liquidity. And this brings us to the second trend, the rise in private credit. In Nigeria, private credit is gaining extraordinary momentum because it addresses many concerns investors face with private equity. Most importantly, private credit offers frequent distributions, often quarterly or semi-annually, delivering a steady stream of cash flows that aligns well with the liabilities of pension funds, insurers, and other long-term asset managers. In an environment with high inflation and limited income-generating instruments, this consistency is extremely valuable. Private credit also offers structured protections such as collateral, covenants, seniority, and shorter maturities. These features provide downside protection while allowing investors to recycle capital faster than in traditional private equity. However, as we embrace private credit, we must do so with discipline. One of the central considerations is default risk. Higher yields often reflect higher borrower risk and rising default rates, especially in stressed sectors or FX-exposed businesses, which can erode returns. This makes rigorous underwriting, strong governance, sector specialization, and active portfolio monitoring essential. Nigerian institutions must ensure that managers have the expertise to structure deals appropriately, enforce covenants, and navigate workouts when necessary. The third major force driving private markets is the strategic shift among global institutional investors. Many now allocate as much as 40% to alternatives, motivated by the opportunity to earn higher returns, inflation hedging, and exposure to real economic activity. Yet, Nigerian institutional investors are still materially under-allocated, often below 5%. This is a missed opportunity. Local investors understand the Nigerian market better than any foreign participants. You know the political cycles, regulatory dynamics, cultural realities, and the true risk-adjusted potential of businesses operating here. When local capital participates, foreign capital follows, and a powerful catalytic effect occurs. By increasing allocation to private markets, particularly private credit, Nigerian institutions can improve returns, diversify portfolios, support business growth, and contribute to national development priorities, which include energy transition, infrastructure, manufacturing, agriculture, and digitalization. Private markets are not the future, they are here. Private credit with the regular income, shorter duration, and structured protections is the bridge that Nigerian institutions increasingly choose. And with careful attention to default risk, it can be a resilient, attractive, and catalytic asset class. The question is no longer whether institutional investors should participate, but whether local capital providers can afford not to. Thank you.